This video is called What Everyone Needs to Do with Their Money ASAP.
What's up, you guys? It's Graham here. So I had another video that was scheduled to post today, but with the current state of the economy and the rather unprecedented events that we have just seen in the stock market, I felt like it would be more appropriate to address everyone's concerns and share my own thoughts about what's going on. Because the reality is, many people have just seen years worth of savings completely wiped away in a matter of a few days, with the market falling faster and further than at almost any other point in history. That's why we really have to discuss exactly what's going on, what this means for you, and why it's important not just to invest your money, but also protect it, because right now could be one of the most unique times in history. Although before we start, as usual, if you appreciate me filming in not my studio while I'm out of town to get this video out as fast as possible, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. Yes, I get very tired of asking for it, but it does help the YouTube algorithm tremendously. And as a thank you for doing that, I will do my best to read and reply to as many comments as I can. So thanks so much. And also big thank you to Incogni for sponsoring this video, but more on that later. All right, so in terms of what happened, all of this started with the informal announcements of worldwide tariffs going into effect on April 9th. Initially, the plan was that this would bring manufacturing back to the United States. We can negotiate favorable trade deals with the rest of the world, and it would bring back demand for more locally made products. But when those tariffs were revealed, it was significantly higher than anyone expected. And as a result, the market immediately began selling off. After all, this really could only go two ways. Scenario A is that Trump announced significant tariffs to the rest of the world. They realize he's not bluffing. The market goes down, but other countries quickly try to negotiate a deal, knowing that it's going to hurt them more than it's going to hurt us. Or scenario B is that Trump announces these significant tariffs. The rest of the world doesn't back down, and it becomes a stalemate to see who gives in first, with the biggest contender being China because they're one of the largest trading partners. And if that happens, it's truly an unprecedented event, and we have absolutely no idea what could happen. Even though this one is going to be impossible to predict the future, we can look back in the past to see exactly what's happened during previous market crashes. And this is where things get very interesting. In terms of how bad things could potentially get, take a look at the year 1907. This is a time when the stock market crashed 50% after the 1906 San Francisco earthquake, when heavy insurance payouts caused people to withdraw their gold from banks. Of course, that resulted in people cashing out, the stock market collapsed, and fun fact, but that actually led to the stock market and fiscal policies that we have today, known as the Federal Reserve. But shortly after that 50% sell-off, the stock market wound up surging 193% over the next 4 years, and that continued until the Great Depression of 1929. Back then, the issue is that banks were lending out so much money to anyone who wanted to borrow for the sake of investing because the stock market just kept going higher. Well, once the market began topping out, people started selling, panic ensued, people began withdrawing their money from the banks, and the banks couldn't afford to give people their money back because they had loaned it all out for people who wanted to invest. This led to the stock market dropping 83% over almost 3 years, with a nearly 25% unemployment rate among Americans.
Ooh, dropped 83%. Yikes.
To make matters worse, tariffs were placed on foreign imports with the thinking that that would help drive demand for locally made products. But in actuality, that entire plan backfired and made the entire situation that much more severe. In fact, the market didn't recover for almost 20 years when World War II offered enough work for the 17 million Americans who were unemployed, at which point the stock market started going up another 14 years with a gain of 815%. Although after that, as the war ended, we saw another drop of 22% now that the government was spending less money and some of those veterans re-entered the workforce but couldn't find enough work. But after that sell-off, we saw 15 years of solid growth with prices increasing over 935%. But then in 1973 and 1974, the stock market lost another 40% of its value. This occurred when President Nixon removed the dollar from the gold standard. This caused prices of everything to skyrocket out of control. The Federal Reserve quickly raised interest rates, and that caused the entire economy to collapse. But eventually, like clockwork, the market recovered, and over the next 13 years, the average gain was 845%. But then we have another one that a lot of people seem to bring up lately, and that would be Black Monday of 1987, when the stock market lost 22% in a single day. However, that one was very short-lived, and over the next 13 years, the market ended up rallying another 800%. Then we have
I have a feeling that the video is basically saying, don't sell, just hold through these crashes. I have a feeling that that's where he's going here.
Short-lived, and over the next 13 years, the market ended up rallying another 800%. Then we have the dot-com bubble of 2001, which was caused by a frenzy of internet-related companies and people buying into them because they thought that the internet was going to be the future. But none of those companies ended up making any money, and when they finally collapsed, they took the entire economy down with them, with a lot of the market falling between 40 to 60%. But even after that, we saw another 5 years of growth, with the market increasing 110% until the Great Recession of 2008. I'm sure this doesn't need too much explaining, but basically banks lent out way too much money to people who couldn't afford it. And when people began defaulting on those loans, banks themselves couldn't afford to pay back their investors, and the banks went out of business. This caused the stock market to fall as much as 40 to 50%. But then we recovered with one of the most profitable and longest running bull markets in history until COVID, when the markets fell another 30%. To help with that, the government printed a lot of money to keep our economy afloat, and that resulted in a 120% increase over the following 5 years. Until now. At the time I'm recording this video, the S&P 500 is down about 20% from its peak. And in terms of what's most likely going to happen next, you're 100% going to want to hear this. Although before we go into that, just like it's really important to protect your finances and your investments.
Now we're gonna skip this ad, but I've not watched this video, but I'm betting money that he's gonna say, just hold through it. It's gonna come back, and when it does, it's gonna be multiple hundreds and hundreds of percents. And what I'm gonna tell you is you can sidestep those, and then you don't have to you don't have to stress, and B, you could actually be buying the dip on the right hand side when stocks are crashing up versus stocks are crashing down. So that's just what I'm assuming is about to happen. But like I say, we're going to skip his ad here.
You have a right to protect your data brokers and your data market by conducting. They keep you a full refund if you're plan when you go to. You can always try them. Keep in mind that throughout history, there's always a good time not to invest. Even though it's very easy to think that events like this are really rare or uncommon, when you look throughout history, they're actually...
Okay, Kevin, let's do it. Let's do it. If you think that he's going to say, buy... I'm sorry, no. Let me rephrase that. If you think he's going to say hold through the dip because it's going to come back up and it's going to be amazing, we're all going to be millionaires because of it, type a 1 in the chat. So number 1 in the chat, if you think he's going to say hold through the dips, it's always going to go back up. Type a number 2 in the chat if you think it's something else. If you think it's something else, type a 2 in the chat. Okay, we're getting all the ones already. Got about 1 million ones here. Oh, but Trifox says it could be a 2. Trifox may have watched this video already, so he could be right. Okay, we got some 2s. All right, very cool. More 2s than I expected. More 2s than I expected. He could say that. Okay. Cool. Thank you all for participating. Let's see what he has to say.
Actually, a lot more frequent than you would expect. Like, just take a look at this chart here. As you can see, over the last 80 years, almost every decade, there's something that happens which causes the stock market.
Let's make this more bigger. So, Germany annexes France, 1940. Pearl Harbor. North Korea invades South Korea. Arab-Israeli war, President Nixon impeachment, Iranian hostage crisis, first Gulf War, 9/11, Brexit, intervention in Libya. All of these things have been black swan events. Okay.
Market sell-off. But over time, eventually it recovers and we continue moving on as normal. Like, here's the thing we need to realize. Even right now, at the time I'm making this video, prices have only fallen to the point that they were at just over a year ago. And objectively, the S&P 500 is still up significantly when you look at the last 5 years. Put another way, imagine the stock market's a crazy, eccentric person, and it tells you, if you give me your money over the long term, I'm going to give you 7%. But here's the thing, just earning 7% a year is really boring. So here's what I'm going to do instead. Some years, you're going to make 50%. Other years, I'm going to take 50% from you. And some years, I'm going to give you nothing. It's just over the long run, you're going to average 7%. But some years are going to be really good, and other years are going to be bad. Okay, that's my really weird impression of the stock market. But
I appreciate it. As somebody who does voices and impressions, I appreciate that a lot.
basically, when you look at a chart over the last 100 years, here's what it looks like. Obviously, green is profit and red is losses. But overall, there's a lot more green than red. But there are some red years of 17% losses, 23% losses, 30% losses, and even 40% losses. Although guess what? After every single one of them, there are years, and usually multiple years, of green. And if you had panic sold to try to find the bottom, you would have missed out on some pretty substantial profits. In fact, this is a funny picture I found on Reddit that summarizes this perfectly. It starts off by buying into the market, seeing some profits, being...
Oh, hang on. This is going to be the market cycle. This is exactly what the market cycle is going to be. Hang on. All right, we're going to compare his to ours. Well, it's not mine. I found it on the internet. I may steal this one later too, but we'll see.
Happy that you didn't wait, but then seeing the market drop, being excited about the market dropping because you get to buy more, then all of a sudden it keeps dropping.
No. Go back. Ah, the price is going up. Let's watch the market. The trend is holding. I'll buy at the next consolidation. Damn, I missed the consolidation. But what if I wait any longer? I won't profit from the trend. Let's buy. Okay, so this feels a lot like the euphoria up here, or the complacency even. Oh, you know what? It's I'm just gonna buy, right? I won't profit from the trend, so let's buy. Good thing I didn't wait as it continues to go up. Okay.
Didn't wait, but then seeing the market drop, being excited about the market dropping because you get to buy more. Then
Oh my gosh, how many times have we seen the Joker saying things like this? I'll use this correction to increase my position. Brilliant at this price. Oh, brilliant at this price. Let's double it. Ouch, as soon as it goes back up, I'm selling. I don't believe it. It's about to
all of a sudden it keeps dropping and you start to panic. Things get
it's down to 8.25. It's hit its absolute bottom. Oh my gosh, yeah. This is exactly the right-hand side of the market cycle. Complacency, anxiety, denial, panic, capitulation, anger.
even worse. Things continue to get worse. Then you sell at a massive loss. Things drop even more.
Okay, let's wait for it to recover. Otherwise, this will have to be a really long-term investment. What's the SEC doing about this? Enough, I'm selling out and staying out. This is exactly what's happening with AMD, right? This is exactly what's been happening with AMD. Right? People are all the way down this slope saying things like, I don't believe it. It's hit the bottom. Let's wait for it to recover. Otherwise, this is going to be a really long-term investment. Oh, yikes.
You're glad you waited. Then things start turning around. Prices go up. You hold out, expecting things to drop even more. And then they don't. So eventually you buy back in.
Yeah, here we go. So now it's going up, right? This is called the wall of worry versus the slope of hope.
At the same price you did originally, except now you lost a lot of money. I hate to say it, but this is very true of so many investors. I've seen so many people do this in 2009, 2010, 2018, 2020, and I'm sure even again recently, where they sell out of the market, they wait to buy the dip, they never buy the dip, they hope it keeps dropping further, but they end up missing out on pretty amazing profits afterwards. Really all I'm getting at is this. For the last 120 years in the stock market, the only consistent strategy that has always worked is to buy and hold on a regular basis with a time frame of 20 to 30 years. That's it. I don't know why, but for some reason, the stock market is the only thing where if prices end up falling, people go into a state of panic. And really, from my perspective, unless you're planning to cash out and retire in a few years, whatever the stock market does in the short term is completely irrelevant. Like, you wouldn't go in panic.
Oh, I disagree. I disagree bigly. In fact, let's look at I mean, we could look at today, right? We don't know how long it's going to take for this to recover, right? So peak to trough, we're looking at 20, I mean, we're talking 20% down right now. 20% down. Or you could get out when the 10 crosses under the 20 and price crosses under the 50, because you know for sure, hands down, no doubt whatsoever, that when this occurs, that this is a bearish trend. And then you can skip all this down move and you can wait for the up move. In fact, we could look at this on the COVID time frame. This is not the first time you've seen me do this, but I like to illustrate with it. I like to illustrate with it because it's a real example of a 35% drop where people were saying buy the dip all the way down, right? When the stock was down, you know, I don't know how much this was down. When the market was down about 7% or so, people were saying buy the dip, buy the dip, buy the dip. It ended up going down 35%. And let's say if you had bought the dip on this side, right, it would have taken you from March to June to get back to break even. But in fact, let's make this even more better. Let's do this even more better. Where did the 10, 20, 50 cross? That's what I want to know right now. The 10 crossed under the 20, price closed under the 50. Let's call it on this date right here. This exact candle. This candle of February 24th. Okay? So let's say on February 24th, you were a smart investor, you were an outlier, and you're like, whoa, listen, the market just changed directions very quickly. You even could have got out a day before that very quickly. I need to step aside for a minute and see what's going on. And it went down a lot. Now, we don't always have these V-shaped recoveries, okay? And so the person who held it at this point is back to break even from February until June, so 4 months later. But if you had waited for the crossover the other direction, the 10 over 20, price over 50, I would say it would be this candle right here. This candle right here. And then you're like, okay, well, we've turned around. And yeah, you might have lost a buck or made a buck during this time, but let's just use this as whole numbers here. 15%. You could be up 15%. You could be up 15% by buying it on the right-hand side of the curve instead of holding it on the way down. So you would have kept all your gains, skipped this, and then added 15% just to where that person would be back to break even here. Come on. This is why trading matters. This is why being market aware matters. This is why you need to be following the outlier trend template. Because in a situation like we're in today, right, you could have got out with the 10, 20, 50 cross down here. And from this point right now, it's down how much? From that point, down 16%. Down 16%. We don't know where it's going to come back up, but we could put this line on the chart and say, okay, your opportunity cost of holding this down and not taking this over here was 15% of your portfolio. You could have added 50, you could have added tens of thousands, hundreds of thousands of dollars for some people in the span of this right here, while other people were just trying to get back to break even. Am I making my point clear enough about how important it is to A, be market aware, and B, follow the trend? And this applies to every dip. Buy it when stocks are crashing up, not while stocks are crashing down.
If all of a sudden the iPhone goes on sale for 50% off, right? Instead, you would see that as a good opportunity, and you might even just buy another iPhone because you see, oh my gosh, this is a 50% off sale right now. That's a fantastic deal. I'm going to go and buy another one. Well, how is that different from the stock market if you're not planning to retire anytime soon?
It's a lot different. It's hella different. In fact, let's think of it in real estate terms. This is not iPhone terms, right? An iPhone is a consumable. You're going to use it for a couple of years. It's going to depreciate over time, and you're going to get a new one later, right? So let's say I bought this. So this is an iPhone 13 Pro, right? This is an old ass phone at this point, right? And you can see the yellow case I put on it is all kinds of marred up from, I don't know, like I really don't know. Whatever's in my pocket apparently has been making the phone case change colors. But the point is, my consumable good is designed to go down in value. Okay, we know that because there will be a new iPhone 14, 15, 16 that comes out later. My assets, however, are a very different story. My assets, however, are the opposite of this, right? It's equivalent to saying, I'm going to buy a house in a new neighborhood, right? I've researched, I flew out to Texas because Texas is the greatest state in the US. And I went around and I saw which cities are starting to pop, right? They're building new schools. They just finished the big construction projects through the city, right? So the infrastructure is there, and I don't have to deal with 10 years of construction. They just put in a Starbucks and a Home Depot and a Walmart, and best of all, they put in a Texas Roadhouse, if you can believe this. This is awesome. This is where I want to be. And as you're doing that, that's what it's like to be on the uptrend, right? You see the house, the asset that you want to buy, going back up. I'm sorry, going up because, hey, people want this asset. People are clamoring to own this asset. Now, on the other end of it, you're looking at this neighborhood and, you know, you drove through it and you're like, it looks a little bit sketchy, right? And you see on the corner a couple of guys shaking hands and you see one guy walking away, sticking something in his pocket as he shakes his hands. He's like, all right, that may have been some sort of drug dealer or something going down. I don't know. I'm not going to judge anybody. And then you see some police cars chasing after people, gunshots ringing out, and you're like, oh, yikes. And then the house that you wanted to buy, all the windows are boarded up. It looks nothing like the picture on the internet. All the windows are boarded up, and your realtor says, are you packing? And you're like, what are you talking about? And you're like, listen, this neighborhood is not good, right? You can't come into this house unless you've got some heat on you. And you're like, what? This is my investment right now? This is what I want to buy? It's the difference in an asset versus a consumable good. You want to be buying an asset as the asset is growing in value, as everybody else wants to own the asset, which is pushing the asset up higher, right? When everybody else is wanting to own the asset, it pushes the asset up higher. However, when everybody else is saying, I don't want this, this is sketch, this is not a good neighborhood, right? Everybody's screaming sell, you don't want it. You don't want it. And if it's down 50%, that means the market is telling you nobody wants it. And if you think you are more brilliant than the market to say, as the market's going down, I'm so smart, I'm going to buy it as it's cratering, as it's cratering, let's look at AMD to see an example of a stock that's cratering. Let's go find where it was down 50%. Let's go find a stock where it was down 50%. Let's go find from the peak to trough, it was down 50%. Let's say 46%. We'll round it. It had lost 50% of its value, peak to trough, give or take, at 120. And since then, it's now gone down another 36%. Since the 50% loss, it's now down another 36%. And you're telling me that buying the crack house stock is a great investment? No, sir. No, ma'am. You can't convince me of this. No, I would not buy this with your money. No way. And the reason is because if you are an investor and you want to be making money in the market, I got big news for you. Only price pays. Only price pays. And the only time price is going to pay is when price going up. Good gravy. This is not like consumables. Assets and consumables are very different. And you do not need to treat assets in the same vein as consumables. When the asset prices are going down, you need to step aside and wait for those asset prices to start going back up, because your account is not big enough. Your account is not going to be enough to cause it to go back up. But you can throw 3 trend lines on there, and you can see when everybody else is helping you, when everybody else is there with you, screaming to buy, that, my friends, is when the prices will start to go back up. Like I say, buy the stocks while they're crashing up, not while they're crashing down. Come on, Graham Stephan, you know this.
If you own stocks and you intend on holding on to them for another 10 to 20 years, what does it matter if we see a 30% drop temporarily in between then? You should really see this as a Black Friday sale, where all of a sudden you're able to buy the same stocks that you were able to a few months ago for significantly less. And this, to me, is where a lot of the money's made. Like, imagine you went and bought some eggs at the grocery store, and then you go back a week later and those same eggs are 30% less. You wouldn't think to yourself, oh, darn, I overpaid for those eggs. You'd probably just think, oh, great, you know what, I buy some more eggs and now they're cheaper. The same thing applies to the stock market.
No, it doesn't, because eggs are consumables. Very different.
That's why I've never understood why people panic so much when the stock market goes down, or they think
And you don't have to panic at all. In fact, I've been sitting in cash, cool and pretty, with 40% of my hair left. You don't have to panic at all, but you do absolutely, hands down, for sure, for the rest of your life, need to understand trends. And like I tell you guys all the time, right? Every once in a while, the trends will make you a buck, lose a buck. But you be on the right side of the trend and out in cash, or be on the right side of the trend and making money as it's going up. You can't tell me trends don't exist, because you're not getting paid unless the trends exist.
it's an apocalyptic scenario that we're never going to be able to recover from, because history has shown us time and time again that the market eventually will recover. In my honest opinion, I think the biggest risk with this market is for people who panic sell, for those who decide not to invest, or for those who invest in very risky assets in hope of making a lot of quick money, but instead they can't afford to stomach the losses. In those cases, yeah, you might actually have legitimate problems, but for those who stay employed, keep their plan as usual, and continue buying in despite the lower prices, long-term history has consistently shown that you're going to be just fine. Not to mention, price drops like this should really be seen as one of the biggest opportunities out there. For instance, in a weird way, the 2009 Great Recession.
It'll absolutely it'll be a fantastic opportunity on the other side. It'll be an amazing opportunity for people to have bought the dip on the other side. But you don't have to hold it through this. And you certainly shouldn't be buying through this, because you don't know where the bottom is going to happen.
Was a once-in-a-lifetime buying opportunity for people to buy into things that they never would have been able to otherwise. Like, I
On the way up,
bought full-on houses in California for $70,000. Seriously.
so he was buying the crack houses. So Graham Stephan was buying the crack houses, right? Graham Stephan was like, I'm such a genius. I'm going to buy this house as it's going down. I can't even be seen in this neighborhood because I feel like I might get kidnapped and held for ransom. And he was the guy buying it out there. Bro, you got bigger cojones than I do, because I ain't doing that. No way. But you know what? You clearly you're a genius.
Houses. Stocks were also trading at a fraction of the value that they are today. And I actually remember buying Ford stock in 2009 for $2 a share.
You know what? By all means, buy all the mess you want of at $2 a share. Because, I mean, how much lower could it go, right? It's just $2. Who cares? But you didn't get paid until it was going up, my friend. You did not get paid until the right-hand side of the curve showed up.
Real talk, not enough people are saying this, but riches are made in recessions. Now, we shouldn't try to time these recessions, but when they do happen, it shouldn't be a spooky thing. You should just be looking at this as a 100% amazing opportunity. In my mind, now is the best time to take a proactive approach to your finances by living below your means, going through your expenses, cutting out anything you don't absolutely need, and then seizing whatever opportunities in front of you. If people ask me today if it's a good time to buy into the markets, I would argue yes, as long as your time frame is the next few decades and you have a consistent income to stick with your plan as usual. And don't get me wrong, I have no idea what's going to happen in the future. Maybe the markets go up another 20% from here, or maybe they go down another 20 to 30%. I have no clue. Just place a strong emphasis on staying employed, keeping your expenses low, beefing up your emergency fund if that's something you need, and then carrying on the usual plan to dollar cost average long term. If anything, just view this as a test of your willpower, not to panic and not to get ahead.
Why the frick would you want to do that? No, do not view this as a test. What is this? Like a powerlifting competition? No, this is investing. This is not a test of your willpower. This is not to see how much you can bench press. No, dude, this is your livelihood. Step aside when the trends are going down. Step aside. Let the professionals do this, okay? You don't know what you're talking about. Just step out of the way and let somebody who knows how to follow trends buy when it starts coming back up, rather than tell people, just grow some bigger balls and buy it on its way. I almost said a bad word. But I wouldn't do that for you guys. We got children watching and my parents, and they're old. They can't handle that kind of stuff. So what is the market telling us? What is the market telling us today? Let's go take a look at it, right? And we do that by looking at the master key. So first off, we know the trend is down. We don't have to exploit that anymore. The trend is down. Let's go look over in Outlier. So we have one new buy signal. 30 new sell signals. The one new buy signal is on Central Garden and Pet Company. Several sell signals came through, like Buckle still around, Centerpoint Energy, Eldorado Gold Corp, PVH, and SPS Commerce, among many, right? And so what this shows us is our market breadth. Now, market breadth is essentially how many people are screaming buy and sell. Market breadth is what we're trying to measure of these people right here. How many buy signals do we have versus how many sell signals do we have? So we can measure that here on the chart inside of Outlier. So the green line shows how many stocks have buy signals, and you can see it's getting less and less and less and less. And now it did go up a couple weeks ago, which is what I said. You could go, the receipts are on YouTube. I said look for a short covering rally, which is exactly what we saw. And then it peaked, it turned around, and it's continued to go down. Exactly what we see right here. This is not the time to be buying. This is not the time to be buying at all, because the market breadth is going to push the market higher, right? The more stocks that are getting bought is going to push the market higher, right? The market is a consolidation of stocks, right? It's a basket of stocks. When those baskets are getting more expensive, that's going to push the market price higher. If those baskets are getting less expensive, then it's going to push the price lower. So until the baskets start getting more expensive, there's no reason to buy. No way. No way. And then you can look at the market breadth, or I should say the sector breadth. But the SPY is still sitting on a buy signal, ironically, right? But that's because I believe that signal should be interpreted as a time to take off your shorts versus a time to go long. We'll look at that just for a second here. Yeah, this would be a time to take off your shorts versus a time to go long, as we can see. A buy signal within a downtrend should be interpreted as such. So the question I have to ask you is, what did you learn from this video? This is something I want to start doing. In fact, let me copy my slide. It's not where I thought it was going to be. What did you learn from this video? Put in the chat, what did you learn from the video? That's what I want to know. Where is my slide? Sorry, it's not where I thought it should be. It's like, where is it? Did I delete it? Hang on. Put in the chat, what did you learn from this video? Here it is. What did you learn from this video? I got to move it over to the other spot here. So what did you learn from this video? While you put that in the chat, let me introduce myself. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And don't forget the Outlier 3.0 giveaway over at outlierdeal.com. And today's secret code is money. Today's secret code is money. So like I say, what did we learn from this video? What did we learn? Yeah, Mark, only price pays. I learned that Chris needs a new phone case. No, I don't. That is so low on my list of priorities. I don't care. I don't care. But I do like a brightly colored phone case. It's just this one, like, I don't know. It's got like jeans dye or something that's rubbed off on it. I don't know. Whatever. I like a brightly colored phone case because it's a lot easier to find them when you drop them in the middle of the night or really in a restaurant or anywhere else, right? Sit in cash. Cash is king in times like this, right? Patience. Very good, Gary. I agree. Manny says, only price pays. Richard, stay out of the market. Only price pays. Okay, I knew that, but I learned it from you. Very cool. Patience. Don't view stocks as an iPhone on sale. That's a great point, Tony. Yeah, that's a really, really great point. Don't view stocks as an iPhone on sale. A consumable and an asset are very different things here, and you don't need to treat an asset like a consumable, right? You wouldn't you wouldn't treat them the same because they are not designed to be the same. A phone is meant to be replaced. An asset is something that's meant to grow over time. An investment. You're not making an investment in that phone. I mean, you can make money from the phone, of course, but you're not making the investment in the phone itself. There's even more jokers on the internet. Yep. Dennis says to sit it out. That's a really great answer. Han says no mo FOMO. Finally. Yeah. So this is cool. I actually really like this better than the ranking. I like to hear what you've learned from these, right? Avoid dollar cost averaging like the plague. You can dollar cost average, but dollar cost average when stocks are crashing up, not when they're crashing down, right? I learned what not to do. That guy was flipping my flapjacks. Man, he says, don't buy crack houses. Yeah, don't buy a crack house as a stock for sure. I learned that I could have played Helldivers 2 instead of watching that Joker. Same as the others. David says how to lose money. Anthony says, I actually learned how to keep my money in my account, not someone else's. Anthony, that's a really good one. That's a really good one. Brian says, don't listen to most YouTubers. Yeah, I try. Thank you for that, Brian, for that little introduction there. I try and make my videos better than most people's paid courses. And you can see why. Right? So be sure you sign up for the afternoon live stream over at summit.trader.com. I hope to see you over there. Like I say, there will not be an afternoon live stream like normal, but I'll see you over there where outliers like us will save time, make money, and start winning with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you watch one of them, and I also recommend you go and join the summit, and I'll see you this afternoon.